Good morning, everyone.
Good
morning. Perfect. As you can see, the first task has been solved. Each of us made a challenge to take the right chair under our name. So that's good, especially for me in the morning. So again, a very warm welcome to all of you here at the AI House at Davos. My name is Holger Kneisel. I'm a member of the Managing Board KPMG Germany, responsible for the advisory business, including any M&A stuff. But however, today I have the great pleasure to step out of this job into the moderator's seat and to moderate a panel with an, as I think, incredible, relevant topic. So we are here to explore the question of reshaping boardroom, which reshapes boardroom agendas, investor expectations, and strategic decision-making all around AI. And the question is, as you could already see from the agenda, what drives the deal? And the new logic of M&A. Perhaps we find out whether there is a new logic or whether it's still the same logic. So the way companies create value, the way they evaluate strategic opportunities, and even the way they run the process itself, that's all being transformed heavily through AI. And this panel brings together fantastic perspectives, I promise you, which will help us to see whether this all may end up at the end of the day. So thank you for joining us to this panel, and I would like now to introduce our speakers for this fantastic panel. So first of all, I'd like to introduce Eva Scherer, member of the Managing Board and CFO of Daimler Truck. Daimler Truck Holding would be the perfect term. Eva, thank you very much for making it today. Next, we have Dagmar Mundani, Corporate Vice President at Siemens, responsible for mergers, acquisitions, post-closing, and government engagement. Quite an interesting mix. So it's great to have you here in the morning. Thank you. And our third panelist is Alexander Meyer, Dr. Alexander Meyer, I should say. Alexander is head of JP Morgan Germany and Austria. Important, I've been told, and senior country officer. And Alex, thank you for coming here. We know each other, I guess, since 25 years when we started our careers in different parts. So as you can see, we've gathered experts from industry and financial services to cover today's topic. And I promise you, I'll make sure that we will have enough time at the end of the session so that you can shoot your Q&As. They are all well prepared, I guess, for any questions. So let's see where we are ending up. So I would like to start now with the first question. I would like to start with you, Dagmar. AI is described by many as kind of a new industrial revolution. And from your perspective, from your Siemens very practical M&A perspective, who are the biggest winners and losers of this shift with regard to M&A dynamics?
Yeah, I think as we have seen in, especially in the valuations of companies, that of course AI and things related to AI are extreme value drivers. And compared to the traditional industries, and in a way it's no wonder, because with AI it is sort of an industrial revolution, and it's a real driver in how we do things, and is quite disruptive for, I would say, for most industries. So as we see, of course, acquisition of OpenAI with Microsoft, extreme values, that's of course a bit of a lighthouse topic, and also is quite obvious that if you can take AI into a suit like Microsoft's, that's extremely value driving too. So it's not just a hype. I mean, there is a big discussion, is it inflated? But of course, the pure algorithm, and if that matches with a business model, is an extreme opportunity. But also not only the AI algorithms per se, but also what AI is in other products, in potentially traditional products, can drive a lot of value, because you can do things differently and create a lot of value by being more efficient. And then you have, on the one hand, really the AI part, and you also have the infrastructure that is necessary for AI creation, because AI itself is not cheap. Yeah, you have to have the right data. You need a lot of energy. So the availability of data, the cost of energy are real drivers, and also the availability of the training facilities, the gigafactories. So what you also see in terms of the M&A environment, that there is also a very strong value creation on those who provide the infrastructure. And then, of course, if you say the losers, you never know, because there is still a lot of traditional industries that not necessarily losing. It may not participate in the extreme differentiated valuations that we have in an environment that creates such opportunity. If you think about a real loser, it may be someone whose business model is destroyed with AI. Yeah, and I mean, as we were driving here, maybe, I don't know, maybe some parts in advertising, or where the job is done by AI, if you don't transform your business in a way to adapt it to that, then it may be also a destructive force and may lead to an effect that companies are losing if they don't participate in a necessary development. That's how I would see it.
Yeah, thank you, Eva. Dagmar, that brings me pretty much to the follow-up question then. You're doing a lot of M&A. So when assessing those potential targets, how do you evaluate the strategic relevance of AI within the business? So whether it's on the one hand, let's call it a core capability or key feature, or even on the other hand, a potential source of disruption. So i.e., you basically want to avoid that they become a loser after you acquired them.
Yeah, I mean, in the end, it's always depends on how a business model is changed. Yeah, if AI is part of what you are doing and you can put it into your business model, you can basically see maybe get a better price, because I mean, as we see it, AI will make things a lot more efficient. Yeah? For example, one of our recent acquisition is Dotmatics, that's in the pharma space and also obviously chemistry, and it helps you to design drugs much faster. And so if you can, for example, change the time to develop a drug with an algorithm from 7 years, which would be the traditional approach, to a 3-year term, you can imagine how much more efficiency you get, and also how you reduce the risk in the pharma environment, because the investment it's just so much clearer in an early stage if it's going to be a success or not. And what you can then do in addition, you can match the development of the drug with the production, so you get a lot more integration. And here, if the value you create is so visible, and you can imagine that also the customers will pay for it. And then the question is more, of course, the customers benefit. We have to participate in the value creation, and probably also the end customers. So it's a little bit really like in the Industrial Revolution, that you make things a lot faster, and of course then also in terms a lot cheaper, and then everybody benefits. Yeah? In the end, the consumers benefit, but also the companies who participate in that value creation. But it's, of course, not always easy, because you don't know at what point in time how much you can transform it. So, I mean, it's like every valuation. Yeah? If the end part is not totally clear, there is a certain element of risk in it.
Of course, yeah, but nevertheless, it sounds to me like pretty much a rational, non-hype process, so to say. So that brings me to Eva, this time the right person for the right name. How does Daimler Truck navigate the fast-moving AI landscape and avoid a hype?
Yeah, that really is a key topic, because what you need to know about Daimler Truck is, I mean, we're currently in the biggest transformation the industry has ever seen. I mean, for 130 years, we've been selling combustion engines in our vehicles since our founder, Gottlieb Daimler, invented the first truck. And now we're moving towards zero-emission vehicles, and we're investing into 3 technologies at once. That is battery electric, it's fuel cells, and it's hydrogen combustion engines. And at the same time, we still need to keep investing into diesel to develop the next level of efficiency, because in quite some parts of the world, the transformation to zero emission is not moving as fast as at the moment in Europe. It is moving at the fastest pace, but I think we all know that in North America and other parts of the world that is different. So 4 technologies instead of 1 means that we're in the peak of our CapEx cycle. And that means for me as a CFO, it's not that I have unlimited funds now to invest into AI opportunities, as important as it obviously is. So what we really see is that our collaborations with early stage VC funds has really gained in importance, because it's an opportunity for us to invest small ticket sizes and be part of the game and really see where do we have funds and fund management that we trust with a clear track record. They detect opportunities, they really look through the hype, clear valuation fundamentals, business cases, and then we see how it goes. We see the path to commercialization, to monetization, and then we are in the process, we have the relationship to executive management. We can then see, can we increase our stake? Can we potentially take over a company? Can we partner? And what are the possibilities for us to navigate that environment? And it's not only sourcing for opportunities where these early stage VC funds are important for us, but also assisting us in due diligence and just being in that ecosystem. I mean, I go to the Bay Area at least once a year to meet also the funds that we're working with and the companies that they're investing in, to see, are we on track? Also, are we developing something in-house where there are actually better solutions externally? Because we're an industrial company with more than 100,000 people worldwide. Maybe we're not always the fastest with complexity of processes and so on. So maybe we trust somebody else to do something. And again, partnering is important. So we work a lot with joint venture structures and also minority shareholdings, and that has proven to be a good way for us. And then we decide selectively where we take bigger bets, and the 2 biggest ones that we're taking are autonomous driving and software-defined vehicles.
Interesting. So pretty much like the speedboat approach, not always have the big carrier doing all of the work and let the speedboats look after interesting targets and let them to get a proof of concept, right?
Yeah.
Okay. I'd like to come back when we still talk about the targets. I mean, AI is a lot about software, of course. And everybody talks about software when they talk about AI, and sometimes you mix it up. So, Dagmar, I know that Siemens is looking since quite a time very much on software rather than all the old traditional stuff they were doing 20 years before. So how do economics of AI-enabled software, you already touched on that a little bit, differ from those of traditional software? And what implications you think does this have then for identifying attractive M&A targets? Because everybody is looking after these unicorn stuff, right?
Yeah, maybe one thing, even 20 years ago, we already invested in software. Yeah. So this is not a recent development in Siemens, but a pretty long, for a long time implemented strategy. The question is then, how do software models change? And they have been changing anyway. As we know, the software model went from a licensing model to a software as a service model, which is, I think, currently the most typical thing in the industry. And the question is if it's enhanced with AI and the level of productivity and the levers for productivity are so high, if that would stay with the software as a service or at maybe a different price point, but depending, of course, on the customer benefit. So I think that's totally thinkable. it could also be, at least what I could imagine, that with this level of productivity you potentially create could be also value-based pricing. But I think that's not really something that's decided yet. Yeah, I mean, as we see it with Microsoft. That suit, if you have the artificial intelligence implemented, it's still you pay on a license basis. Yeah, so I think it does not necessarily change the pricing model. We have to think about it, yeah, depending maybe on really the value creation, especially if customers benefit more or less, yeah, if that really changes the game, or the software as a service model in a refined way, and also, of course, reflecting what additional services you actually provide.
Yeah. Okay, when we then just flip to Daimler Truck again, which AI fields and target types does Daimler Truck look? Yeah? Is it more on the software enabling, for example, the big trend of autonomous driving, or what is basically the focus where, for example, the VC funds you were just mentioning are looking for you?
Yeah, I mean, we have defined search fields. I mean, it's for sure autonomy, it's robotics, it's software-defined vehicles, but it's also fleet management, it's logistics, fintech. But as I said before, I mean, the two main areas where we really place the highest capital allocation is software-defined vehicles and autonomous driving. So we acquired a company called Torque Robotics. We own more than 90%, and they're really an autonomous driving technology company, and they develop a virtual driver software for trucking applications on highway driving. We started with hub to hub. Now we're looking at distribution center to distribution center. And that is something where we are really the only truck OEM who has decided to not only have a small stake in an autonomous company, but really own one, because we believe that's where we have a unique value proposition across our ecosystem, because we start doing that now in the United States, because that's where the regulatory environment is most favorable, and autonomous trucks will be on the road first. And there we are the market leading truck OEM with about 40% market share. So we work with all the largest fleets in the country. So we have the customer access. We know how that business works. And we have a unique business model, because what we developed is for our heavy-duty on-highway truck, we developed a so-called autonomous redundant chassis. That means autonomous braking, steering capabilities, and so on the truck. And then we factory fit the AD kit from our autonomous company, Torque Robotic, on the truck, which is then really product intent hardware that scales quickly. So it's not prototypes, but it's something that we can produce on the production line. And that's also why our path then from commercial launch to scaling is quicker than for other autonomous companies, because they don't have that integrated offering between the vehicle and the software. And then we have obviously looked at also the business model. So the truck, the redundancy in the chassis, that's an option to the truck. But then the AD kit and the software, the virtual driver, that's the software as a service model that gives us obviously recurring revenues, which is highly attractive. And then we have even expanded on this investment now and acquired another company 2 years ago, which is called Algolux. And that's where we really look at computer vision and perception software, because there we have decided it makes sense to have the eyes of the virtual driver in-house, because it gives us the opportunity to reduce risk on the path to commercial launch. It also gives us the opportunity to just scale quicker through even more integration, and it helps us to really have a good AI talent base in that ecosystem. So that is something where we believe we're very well positioned and have therefore also decided to allocate the capital and place that bet. And we're always looking at further applications in that autonomous feature world and also simulation capabilities. And the second big thing is software-defined vehicles. I mean, that clearly is the future, not only of passenger cars, but also of trucks. But it's a significant endeavor, which is why we decided to partner. So we founded a joint venture last year together with Volvo Trucks. And what we developed there is really the software-defined vehicle platform. So the back-end system where we share then data, compute, over-the-air capabilities. And that enables us then to scale AI-ready applications. So the application layer, the front end, that's what every company does themselves. But we need the platform, the SDV platform that works across vehicles, across regions. And this is key for us, but it's a good opportunity where we partner to reduce funding, to reduce risk and build an industry standard and then differentiate on the application layer. And that's where we can focus on, and that's where our R&D efforts then lie. And so those are the two biggest ones, and then obviously everything that's in these search fields, the 6 search fields that I mentioned initially, are what we're looking at constantly.
Alex, we heard a lot of AI targets for these 2 interesting companies they are looking for. So, I mean, your world is also pretty much about doing the valuation for these kind of targets. And we both know, I mean, it's always about kind of a base value, and the key thing to discuss is always the premium. Either is there really a reason why to pay a premium, and if so, what's the valuation to come to this premium? So basically, key question for you, I mean, how do you deal with the question of paying a premium for AI targets at the moment, and how do you evaluate them?
Yeah, I mean, first of all, when we talk about AI and talk about valuations and talk about premium, we are looking actually at a much bigger ecosystem. Yeah, I mean, not only AI software, data centers, power generation, computing power. And the first thing where you would say, wow, why are these valuations justified? You look at the capital flows that go into this sector. And I think McKinsey estimates the capital inflows or capital investment into this ecosystem to 5 to 7 trillion as a whole. And I think we expect hyperscalers to spend this year $490 billion just on AI and AI infrastructure. So you would first make, okay, looking at the capital flows, there must be something that justifies high valuations. But then again, I mean, people are talking about hypes, talking about bubbles. You need to always bring back valuation to, I would call it, 3 basic principles. Number 1 is scarcity. Number 2 is growth. And number 3, it's profitability or cash flows. So when you start then transferring the business case, or the business cases that you described into a financial model, I think you need to model the way these business cases then lead to extraordinary growth, and at some point in time also to profitability and cash flow. Because I think without this, how can you justify paying a premium if you don't have visibility to a case where there is then, I would call it, extraordinary profitability, extraordinary returns, extraordinary cash flow. But it's actually not that easy, because I think what is really the first topic or the first question that you have to ask yourself when you value a business case, proven or unproven. Yeah, proven, I think, there the case to pay a premium is much easier than for unproven. And so what we are doing in these cases, especially for unproven, we actually try to value different scenarios. Yeah, I mean, it's in the end, it sounds like, okay, we have always done this, but what's the base case? What's the downside scenario? What's the upside scenario? And also then last but not least, I mean, also AI has not eliminated, I would call it, the basic or the base law of valuation, which means the relationship between risk and return. So if you see, for instance, for an unproven business model, if you see their higher risk, the cost of capital or the required returns that you then charge, you need to actually increase them. And if this is the case, then you really need to see, okay, are there certain periods where the perceived risk is really reduced over time? Are there milestones? So sometimes what we are doing, we're using various capital costs for various phases of the future development of a company. But I would say in the end, for valuation, I mean, valuation is obviously, in this case, is sometimes more an art than a science. So we are using actually different scenarios. We're also using different valuation methodology. If you would say, oh, we're just using a discounted cash flow model, one scenario with a middle of the road capital cost, you would not actually capture all the complexities of AI. So what we are using, we're using various methodologies in order to then approach the topic of valuation in a way that we're not relying just on one methodology, because again, especially in unproven cases, the risk is just too high to just rely, for instance, on one methodology to come up with a value.
Yeah, I'm glad that you already touched so much on risk, Alex, because usually the accountants are the guys who talk a lot about risks, and this time you did it, so thanks very much for that. But I would like to stay a little bit with the risks, because everybody is talking about risk, but what does it really mean? Which kind of risks you're basically evaluating in a kind of risk assessment? So we talk maybe about regulatory risk. Perhaps in a minute, that's also something interesting to hear from you, Dagmar. Technical risk of the target, what they are actually applying. Will they be able to bring it at the end of the day to a solution which really works? Yeah. Data-related infrastructure risk, that's also what you already touched on. Does the right infrastructure is available? So with all these kind of risks, you already see the accountants are very risk-focused, guys. How do you put them at the end of the day together and value them and say, okay, we've looked at them with our knowledge about the industries. We think this or this could be a base case. This could be the more realistic, the less realistic case. So give us a little bit of examples about that.
I mean, first of all, a topic like AI, unfortunately, not only comes with one risk, it comes with multiple risks. Regulatory, the technological risk, then also I would call it competitive risk, because also, especially if it's a young technology, how can you actually make sure, if you're looking at, I don't know, 3 or probably more, 5 different cobots, cobot manufacturers. How can you actually determine how can you determine which is the winning, which will be the dominant, or at least among the dominant technology, who will be at least among the winners? So that's actually a number of risks that you need to include. And as I said, what we are seeing is that the number of scenarios that we are actually evaluating, is actually larger than you would normally do, where you would have probably a base case and a downside case. I think the number of scenarios and the number of junctions, or the number of switches that we build into our models, saying, okay, let's assume this scenario or this business case will materialize, or let's assume we will get this contract. I think the number of switches and the number of outcomes is just much larger, and I think in the end it is then a combination of business judgment of the people who invest and a combination of experience of us as bankers or advisors, that then we start to down select scenarios. Because let's be real, if you have like 20 scenarios, you need at some point to have the judgment to say, okay, we are focusing on 3 or only on 3 scenarios to value a company. That should actually be the base case. Should you actually have, after these scenarios, too many still uncertainties or risks left, what we are seeing then is that you probably step back from 100% investment, from 100% acquisition, but you rather then look at, okay, can we actually just participate in a capital increase, in a capital in the next capital round, just to see which trajectory is the business taking. I think that's what we are seeing, and that's what actually, if we look at deal making in AI, except for, I would say, proven technologies or proven businesses, the more uncertainty there is, the more risks there are. I think the more people actually rely on what I would call a toe in the water investment, where you see, okay, this sounds interesting, but we're not really sure. So if you're really uncertain, then you just do a corporation. If you
shared risk, right?
Shared risk, yeah. If you a bit more certain, then you take a small stake, and with the increase in certainty, you actually also increase your percentage in ownership. But as I said, it's really difficult, because given in many technologies, the degree of uncertainty is very high.
Yeah. One topic which I would also like to dive in a little bit is this regulatory risk. Because, I mean, corporates like Siemens, Daimler Truck, you need to be kind of entrepreneurs. You need to invest in things very early because you believe in them and you want to be able to deliver in 2, 3, 5 years' time. But on the other hand, you do not exactly know how regulation will look like, especially in this AI stuff. So perhaps to the two of you guys, how do you deal with this kind of issue at Siemens?
Yeah, I mean, sometimes the problem is not that you don't know what regulation will be like in 5 years, but the topic is how regulation is today, right? And I mean, as Eva mentioned it, and I think that's also a topic that really to strike the right balance in regulation between setting the necessary guardrails versus just trying to regulate something that you don't know what you're talking about. I think there is a big gap, and at the moment, I think there is too much regulation with not enough differentiation. So it's like the acts like the Data Act, the AI Act, they treat the consumer regulation like they treat the business-to-business industrial regulations, and that I think is not, it's definitely not innovation friendly. And if you have too many guardrails, of course, that inhibits innovation. Yeah, I think, and if you think about medical development, if the early stages, yeah, I think there is no risk-free probably development if you really want to make a big step. So I think a bit more boldness and trust of the regulators is necessary, and that's what we are arguing also, that they should rethink the policy to reduce it to a level that provides sufficient guardrails versus allowing innovation. And also, I mean, in terms of a competition of systems, also enabling that in Europe. Yeah, I mean, you sometimes can do it elsewhere, but is that really what a competitive environment is going for? So, and then, I mean, future regulation, I think in the end, that's not something you can plan. But what is a topic is not future regulation as such, but of course export restrictions. Yeah, because we have it in the very high-tech sector that since technology is seen as a method in political interaction or as a means to political interaction, if we remember, yeah, the US says, well, don't deliver certain software or technology to China, and China says, well, we don't deliver rare earth anymore. So if you have that sort of competition, that, of course, is a limitation to business models. You cannot say, I have a model and I roll it out and my market is a world market. I think this has to be taken into account, that no need to panic also, because then, but at least you have to think about more what's the core markets, and would it be sufficient if we could do it in that and that market, and could we also live, or do we have a different tech stack for a different market? And I think that's just something in terms of developing business models and, of course, affecting valuations you have to take into account. You don't know everything in advance, but at least in a way take into account that your market may not always be the world market anymore, and think about where to focus and what is essential for your business case and what is a potential upside, but where you probably also see potential limitations. So, I mean, in the end, yeah, it's like with everything, you have to be bold and you have to be still rational, and also no need to panic, yeah, but you have to take different scenarios into account.
Interesting to hear what you at Daimler Truck are dealing with that, but I would incorporate it in a much bigger question, basically. So we already heard about how to choose targets. We heard about the valuation of these targets. So, and then the key question is, when it comes to you, I mean, your business, your M&A department, they've chosen something, they did a valuation, and now it comes to you, the CFO lens, so to say, to look at it. So basically, how do you challenge then kind of these proposals for you? So give us a little bit of the Eva Scherer style, how you look at the end of a day and how you challenge your people when they come up with something which is usually always positive, right? They wouldn't come with something to you which doesn't make sense. So
obviously my M&A department usually does a very good job and I can trust them. But yes, especially looking at multiples nowadays in the AI environment, they can make you feel a bit uneasy. So you really need to challenge the fundamentals and really make sure, I mean, based on what you also said, are there sustainably higher risk-adjusted future free cash flows associated with it. I mean, that's what it all comes down to, and it can come from higher revenues, it can come from lower costs, higher efficiency, a better value proposition, but ultimately it needs to help us to sell more trucks, buses, services, and also it needs to scale across our ecosystem. So the key question is it something nice to have, or are customers willing to pay? Can I sell it across regions, different vehicle types, and so on, or is it really just a smaller application that I can use? And that, of course, defines the valuation. I mean, regulation plays a major role because you need to be adaptable and flexible. For us in a safety-critical industry, you need a safety case, of course, not only for risk management, but also from insurance and liability purposes. But when we look, for example, at autonomous driving, and when I look at how we value our autonomous driving technology company, Torque Robotics, we're only looking at the US market right now, because there we see that the regulation will enable us to commercialize and monetize that technology first, and then also just define freight routes, where we say these will be the ones where we believe that's going to happen until 2030. And that's how the business case has to be justified. And then everything else, a wider rollout, in the United States, beyond distribution center to distribution center in Europe, other parts of the world, that's an on-top opportunity. But we need to justify the investment with what we can see in the next, I would say, 5 to 7 years. Obviously, synergies are very important, tangible synergies. Why are we the best owner for that business? Why does it integrate well within our platforms, our ecosystems, and how can we add value? And we need to think about also integration approaches, because again, as an industrial company with maybe more complex processes than startups, we have the ability to kill these companies, and the innovation and the speed with which they work us very quickly, if we overflow them with processes and guidelines and everything. And then we talk about light touch integration, and that sounds very simple, and it's actually not, because you need a minimal level of governance, but you also need to give them the freedom to maintain that speed and innovative power. And that you need to think of. And then obviously in AI deals, AI talent and how to retain them, and retention schemes, and also, of course, proprietary data sets, they become a valuation item that you need to really look at. And then what value do you attach to them? What are the risks where you have to deduct something? So it's a very comprehensive view that you need to have something, and actually also AI helps you in the process with low value work to give you actually a better risk assessment. But ultimately, you still need to think. I mean, you still need to look at deal structures, you need to look at governance, and you need to apply judgment. I mean, you also said that nobody's going to take that away, even if you have, because also of AI tools through the M&A cycle, you can be faster and you have more intelligence in the process.
Yeah, I would have many, many other questions, but as promised, I would now open it up for the audience that you could just raise your questions, whatever it be. I think we have some mics there, which can then be. So, as always, someone needs to ask the first question. Huh? A lady up front here. Sorry.
Hi, thank you for your session today. It's been fantastic. I'm Janine Crozier, Head of M&A for Baker & McKenzie. Question for you, as we look at some of the challenges you mentioned around your own structures and sometimes the benefit of going outside for innovation, because perhaps outside people are able to move a little bit faster. When you look at assets now, how can you marry together speed and then the speed at which the M&A market is moving and the precision at which you need to balance your own diligence processes? Which one creates the sort of greater weight in your organizations?
I can start. Yeah, that's a tough one because you obviously need both. And I think, as I said, I mean, AI tools through the M&A cycle, they help you to move faster, but I also do think that it helps you to do stepwise investments, to maybe not go in, but go in with a smaller stake or also via a venture fund, and then increase that gradually once you see, is it actually working? Is there a customer? Does it scale? And how close are we to commercialization? But we also, because we know not all of them will work out, and we have to decide for which ones we want to go all in. And then you also have to look at how much money do you actually have to still put in it? What's your burn rate? Because we all know, I mean, commercialization can always take a bit longer. And then burn rate plays a major role as to, like, every year, how much this is going to cost you and whether you're willing to put that in.
Yeah, I think, I mean, in a way, speed probably is not so much the problem, because we can be fast. Yeah? I think what is more difficult is really the strategic decision. Do you want it at what price? Potentially things you can think about even before a process. So I think it's very really important to set your strategic priorities up front. And sometimes you can spend time on a target without a process up front. That saves you a lot of time. And if you talk to private equity, it's the same thing. They are not faster. They focus on a target, they prepare in advance, and they connect quickly. And I mean, of course, you can do that. Yeah? The question is really to have a good strategic process up front. And I think what typically slows you down is you don't know exactly what you want. So yeah, I think that's the main roadblocker, because everything you can do, you can speed up. Yeah? And I mean, the teams, I mean, are super motivated. Yeah, they can do the speed. The problem is just really the decision. And of course, it's not always easy. Yeah? It's not that people sometimes don't know what they want because they don't care or what, but it's sometimes, as we said, with the valuations, with the developments, and so it's sometimes the tough decisions. But they, if at all possible, yeah, they should not be done under the pressure of a deal. So as much as time and energy you can really spend upfront to know where do we want to go, where do we see the value, and then to be really quick in evaluating, is it worth to pay that price, and do we go with it or do we give it a pass, yeah, and do it with a good feeling. And that's, I mean, what I really pressure for also, to say, well, guys, this may be coming up, yeah, or whatever, could be a year down the road, but let's think about it now, because when we're in the pressure of the process, yeah, then you have to be quick, and let's make these fundamental considerations as early as possible.
Any other questions? Yes.
Yeah, hi, my question is concerning corporate ventures. So if you talked about a bit, so our experience is that this is quite a challenge for most of the industry companies in Germany, also in Europe. So everybody started something and the success is a bit different from case to case. And what is your experience about your own ideas of corporate ventures, working with venture funds, and how important you would say is this in this AI transformation for all of us?
So we don't have our own funds. We just invest in funds. So we have about 13 early stage VC funds that we invest in across Europe, the US, and Israel. So we don't run our own. So we don't think that this is the right focus for us. But of course, I mean, we also start small businesses in our companies, where then at some point we do realize that we're not the right owner for them in order to grow them in the most dynamic manner. And that's also something where we need to be very mindful of when it comes to these companies within the company.
I mean, we do, yeah, and for quite a long time. I mean, in a way, sometimes what could be more is, I mean, as Alex, he said this with 20% and whatever. The thing is, it's totally different, if you have 10 or 20% or if you own it. So it's not just a risk topic. It's actually a topic, do you really want the product to integrate it? Or is it just something for you to get some feeling? And I think the right balance, to to what extent you would want actually to buy those companies. I have to admit that also, I mean, sometimes you're successful in exiting them successfully. That's nice, yeah, because you earn money. But the level of really getting into targets that you later acquire is rather low. And I don't actually know the reason for it, but it's true. Yeah? So probably something worthwhile to look into it again. Yeah, because I mean, I know the person, and then to have that discussion, and so also to see, can you inspire each other more? I mean, they get good insight, they get good contact, so that's definitely worth a lot. But the real connects to corporate M&A is quite loose. And it could potentially be more intense, or at least something to discuss at some point.
Yeah, time flies, I have to say. We are already done, 55 minutes. So thank you.
Thank you.